You watch Tyler celebrate a record day trading win while you hold shares in an index fund. 30 years later, Tyler surrenders half his profits to the IRS and quits trading at age 60. You retire with millions. Three guys named Tyler, Greg, and Ryan share identical birthdays and matching paychecks, starting with equal cash. Each man plans to build serious wealth through stock trading. Tyler chooses to outperform the broader market averages. He studies complex price charts, stares at the opening bell each morning, and buys or sells shares before lunch to capture quick price jumps that slower traders miss while watching from the sidelines. Greg prefers a much slower pace. He keeps his specific stock picks for several days or weeks to ride broader market price trends without stressing over daily fluctuations. Ryan takes the exact opposite approach. He purchases a single broad index fund monthly and shuts his brokerage app to avoid watching ticker movements. Tyler appears brilliant during the initial 24 months. He posts weekly profits while his friends see zero account growth. He shares profit screenshots and tells wild trading stories, assuming his peers miss out on easy cash. He checks his daily portfolio tracker and confirms his nightly winning streak. He focuses on the wrong metrics and ignores the exact numbers determining comfortable retirements. You calculate 30 years of compounded returns and find a massive financial divide between the three men. The ultimate millionaire defies standard expectations. Tyler, Greg, and Ryan all start at age 30 with an annual income of $75,000. They live in the exact same city and fall into the identical tax bracket. They share one specific target of growing serious wealth inside a standard brokerage account to support a comfortable retirement at age 60. Each man commits $1,000 to the stock market every month for 3 decades, keeping the capital injection identical. Their execution strategies create the divergence. Tyler chooses active day trading to outperform the broader market. He memorizes technical analysis, studies candlestick formations, and logs into his terminal before the opening bell rings. He executes buy and sell orders within the same trading session to capture micro movements, turning his portfolio over hundreds of times per year. Sitting idle makes him picture missed profit opportunities slipping away. Greg adopts a slower swing trading approach. He holds specific equities for several days or weeks to capture a larger price trend before moving his capital to a new setup. He avoids staring at tickers all day, preferring to review price action most evenings and execute multiple trades monthly. Ryan ignores stock picking and purchases a single low-cost S&P 500 index fund every month with his $1,000 allocation. This single transaction grants him ownership of the entire United States equity market. He skips individual stock selection, ignores chart analysis, and abandons market timing. He completes the purchase and closes his brokerage application. Friends notice their different approaches at backyard barbecues. Tyler entertains the group with wild day trading stories, while Greg shares strong predictions about future market directions. Ryan stays quiet during these financial discussions because telling the crowd he bought the index fund again kills the conversation. Human emotion and hard numbers occupy different spaces. The 30-year results dismantle the assumptions driving the two active traders. Those final numbers trace back to a different beginning. Tyler plays the obvious financial genius during the first 2 years of their experiment. He catches a hot streak right at the start of his trading journey. He posts 4% weekly gains to the group chat while Greg and Ryan stay flat. He boasts about being green for the month and possessing a secret market edge. He mocks his friends for sitting idle while he takes aggressive market action. He uses every winning trade to build his personal legend and views each success as absolute proof of his superior skills. Greg operates in the background buying and selling equities. A few trades succeed, others fail, and his portfolio keeps pace with the baseline index fund. Ryan stares at a boring screen holding his passive investments. He watches his account balance increase, decrease, and grow without any excitement or drama. Ryan shares zero screenshots and tells zero stories. Tyler checks his specific week versus last week's scoreboard, putting himself in first place against his peers. Tyler ignores the hidden costs draining his active trading account. The federal government taxes every winning trade he closes during that exact calendar year as a taxable event on his return. Brokers deduct hidden spreads and fees from every round trip he executes. Tyler omits his losing trades from the group chat. Wall Street trading firms calculated this exact mathematical disadvantage in previous decades. The company behind Tyler's brokerage app omits this mathematical reality. Tyler constructs a massive financial mirage. He remains blind to the expensive illusion taking shape around him. Tyler builds a different narrative 2 years into his day trading experiment. Investors purchase stocks across multiple sectors and push prices to record levels. Tyler places buy orders and secures massive profits over 12 months. He beats his friends and the S&P 500 index. Tyler claims the title of smartest investor in his group chats. He calculates the monthly income he needs to leave his corporate job and trade full-time. Tyler finds the validation he needs to support his daily stock-picking routine. Tyler faces increased market volatility the following winter. He watches his favorite momentum stocks plummet in value and takes severe losses on his largest leveraged positions. IRS agents demand their share the following April. He pays standard payroll taxes on every dollar of his previous trading profits. He reviews his annual brokerage statements and watches his net worth shrink. Tyler loses 50% of his profits to market downturns and pays the remaining half to the government. Tyler reaches the highest point of his financial success during this massive portfolio spike. He mistakes this high point for a permanent baseline. Blind to this reality, he builds new stock watch lists for the upcoming calendar. He forces himself to stare at trading screens for the next 28 years because he believes he can replicate those initial stock-picking victories. Retail finance companies promote day trading with massive advertising budgets because the rapid action generates excitement. Excitement mimics the feeling of winning. Building wealth demands a distinct approach, and rapid trading fails at that specific task. The first hidden cost involves taxes. Holding an asset for over 12 months classifies the profit as a long-term capital gain. The government taxes those long-term gains at 0, 15, or 20% based on your total income bracket. Tyler buys and sells shares within weeks or days. The IRS classifies all his profits as short-term gains. They tax those short-term gains at his regular salary rate. Tyler makes $75,000 a year from his day job. That specific income places him in the 22% federal tax bracket before his state claims its share. He hands 20% of his trading profits to the government each year. That money fails to compound and grow his account. Financial researchers have compiled large datasets tracking retail traders over long periods. One large study monitored every single day trader in a specific national market for over 10 years. Fewer than 1% of those thousands of individuals generated reliable profits after paying their trading expenses. Another research project discovered that over 80% of active traders lose their starting capital. A team studying the Brazilian market found that 97% of individuals who traded for over 300 days ended up with less money than they started with. A famous analysis of American investors showed the most active traders underperformed the broader market index by 6.5 percentage points each year. They underperformed the index every single year. Picture Tyler performing better than 80% of his peers for the rest of this scenario. Give him the optimistic outcome where he generates a consistent profit. Trading involves continuous mechanical friction that drains accounts. Every single transaction carries a hidden price tag. You pay the spread between the buy and sell price. You pay occasional broker fees for executing the order on foreign exchanges. You suffer slippage when the share price shifts a fraction of a cent before your specific order executes. These costs seem tiny on a single trade involving a few hundred shares. You might lose a few pennies on a single share. Tyler turns over his entire account balance 20 times a single year. A tiny cost of 0.1% per round trip multiplies across those transactions. Churning the portfolio 20 times causes 2% of his total capital to vanish into transaction fees each year. He loses that money before he attempts to pick a winning stock for his portfolio. This mechanical friction causes the underperformance we see in the broader data. The broader market does not need to defeat Tyler. His own excessive trading guarantees his defeat. Psychological traps complete the destructive cycle for active traders. The data proves traders sell their winning stocks early to lock in small gains. They hold their losing stocks for extended periods while hoping for a miraculous rebound. They convince themselves the next trade will prove their market genius. A few lucky wins create a powerful illusion of skill. Tyler mistakes random market fluctuations for personal expertise, and he pays a massive premium in lost capital to maintain that belief. He executes frequent trades to maintain this illusion. Greg watches Tyler panic over every tick and feels secure. He avoids the manic pace of day trading. He holds positions for days or weeks, avoiding minute-long trades. Greg assumes he guarantees smarter results with a relaxed pace, but he fails to generate wealth. He makes fewer trades than Tyler. He cuts his friction costs by trading less. He avoids sitting chained to a monitor for 8 hours. He gains an edge over Tyler from these benefits. Greg retains the core problems. He keeps most assets for under 12 months. The IRS classifies his profits as short-term gains. The government taxes these profits at his 22% income rate each year. He continues guessing market movements. He tries to pick the perfect entry point, the exact exit moment, and separate genuine trends from fake ones. Academics document equal financial losses for swing traders and day traders. Most active stock pickers lose to someone who buys and holds index funds. Greg sits in the middle. He loses less money than Tyler, yet he continues losing money. He represents the responsible-looking trap. We mimic the deceptive tactics of trading influencers when we stop the analysis today. We must examine situations where active traders gain a legitimate advantage. A minuscule percentage of market participants possess trading skill. Academics identified a tiny fraction of individuals generating consistent annual profits through pure ability in a major study. These elite traders exist. They make up less than 1% of the population. Every beginner assumes they belong to this elite tier. You gain zero proof of competence from personal certainty. You alter the tax equation by placing your trading activity inside a Roth IRA. The government ignores short-term capital gains inside this retirement account. The government eliminates the annual tax drain, ruining Tyler's returns. You must restrict active stock picking to a Roth IRA and avoid taxable brokerage accounts. You face a big hurdle from human psychology. You gain a superior emotional reward from taking action compared to sitting still. People place a high value on feeling in control of their financial destiny. People hold a valid human requirement for control. You commit a major error when you finance this emotional need using your primary retirement capital. You can spot the underlying pattern connecting these exceptions. You base every justification on strict conditions, apply it to statistical anomalies, or prioritize emotional comfort over financial growth. You cannot alter the mathematics for a regular individual accumulating long-term wealth using any of these scenarios. Ryan builds his lead by keeping the government out of his portfolio. He holds his assets to prevent taxable events while Tyler and Greg hand the IRS a portion of their profits every April. Ryan lets his capital compound without interruption for 3 decades. He gains 30 extra years to multiply money the government would have claimed. Ryan keeps his expenses minimal by buying a single index fund holding hundreds of top American businesses. He pays a tiny fee to the fund and avoids bid-ask spreads. He avoids slippage and the value leak from executing hundreds of individual trades. S&P researchers track professional fund managers over 15-year periods and find 9 out of 10 of these full-time experts fail to beat the benchmark index. These managers command research teams and expensive software. Tyler lacks those resources and faces bleak odds of beating the market. Ryan maintains total control over his tax bill by choosing the precise moment to lock in a profit. Tyler and Greg trigger tax events despite their personal preferences for that calendar year. Ryan preserves serious cash during retirement through this control. He requires no excitement for this approach and generates massive results. Ryan will finish the race and shock everyone at the barbecue with his massive lead. The friends see identical account balances during the first few years. A silent wealth gap forms. Tyler tracks the wrong metrics to measure his progress. By year 5, Tyler holds an estimated $63,000. Greg accumulated funds nearing $68,000. Ryan built a portfolio approaching $75,000. The balances remain tight. Tyler tells the best trading stories at dinner parties. He considers the competition a dead heat. The group faces a clear financial hierarchy at the 10-year mark. Tyler sits at $134,000. Greg reached $154,000. Ryan owns $192,000. Tyler trails the inactive investor by $60,000. He misses this deficit. He tracks his monthly balance and ignores Ryan. The separation becomes obvious 15 years into the experiment. Tyler grew his account to $213,000. Greg holds $264,000. Ryan watches his balance hit $373,000. 2 decades pass. Ryan boasts $656,000. Tyler sits on $302,000. The inactive guy owns double the wealth of the hardest worker. The group hits the 25-year milestone and faces a brutal mathematical reality. Ryan accumulated an estimated $1,095,000. Tyler crossed the $400,000 threshold. The inactive investor holds an additional $700,000 over the active day trader. 5 years remain before they hit the 30-year finish line. Compound interest triggers the peak expansion phase during this final stretch. Picture the trajectory of these three portfolios on a graph. Tyler experiences violent spikes and severe crashes. He sees his account value jump between extremes while making zero forward progress. Greg experiences moderate volatility and climbs at a steady pace. Ryan traces a straight upward trajectory. The chaotic trader and the passive investor steer towards separate retirement lifestyles. 3 decades pass. Our trio reaches age 60. Each man deposited identical cash amounts. They invested $1,000 each month across 360 months. That totals $360,000. Tyler treated stock picking like a demanding career. He grew his account balance to $511,000. Greg took a relaxed swing trading approach and accumulated $812,000. Ryan purchased a single index fund and ignored his brokerage account. He built a portfolio worth $1,778,000. The passive investor secured over 3 times the wealth of the active day trader. Ryan holds a massive lead of more than $960,000 over his friend. We give Tyler the benefit of the doubt in this scenario. We assumed he generated positive returns. Most active traders lose their entire principal instead of walking away with $500,000. Tyler possessed plenty of brain power. He faced 3 specific financial costs every day for 3 decades. The government taxed his profitable trades. He lost capital to brokerage fees. Very few individuals possess the skill to outperform broad market indexes through constant buying and selling. He failed to notice these small deductions during any random 7-day period. He lost more than $1 million in permanent wealth. Your financial picture differs from the final results that Tyler, Greg, and Ryan achieved. You earn a different salary, fall into a separate tax bracket, and follow a unique investment timeline unlike these 3 men. You can calculate the exact monetary cost of active trading versus passive holding over your working lifespan using the calculators available in the Wealth Logician's Vault. These specific tools allow members to input custom numbers and visualize the resulting long-term wealth gap on their personal computer screens. Your screen displays the final dollar amounts. You still miss the heaviest price Tyler paid. You earn more money. Your hours disappear from your life. Tyler glued his eyes to stock charts through most trading days. He added morning research sessions and evening portfolio reviews to that daily routine. Tyler spent 2,000 hours each year on this schedule. He multiplied that sacrifice over 30 years to reach 60,000 hours. Tyler worked a complete second career alongside his regular job for 3 full decades. Greg picked up a lighter burden. The swing trader stared at price graphs and adjusted positions for a few hundred hours annually. He accumulated 10,000 hours across 3 decades. Greg gave up 2.5 full working years of his life. Ryan gave his portfolio a quick glance. A few minutes each month bought his index funds, and he checked the account on occasion. He spent 120 hours on that light routine over 3 decades. Ryan invested 3 working weeks over his entire adult life. You see the final scoreboard now. The guy who ground through a second job landed in last place. The guy who spent 3 weeks ended up more than $1 million richer. Tyler lost his cash chasing market trends and paid a massive fee for the privilege of failing. He surrendered 60,000 hours of his single life to achieve a result worse than doing nothing. Tyler pays that final bill at age 60, and no portfolio return will ever refund those lost years. You step outside the debate between active trading and passive investing to build lasting wealth. Financial gurus avoid pitching this exact method. Marketers ignore the strategy since they lack online courses to sell alongside it. Start by building your core wealth inside low-cost index funds during your working years. You win the math game through lower taxes, reduced fees, and broader diversification. You secure a proven historical track record that Wall Street professionals fail to match. You use this boring financial engine to reach a final balance of $1.75 million. Place the bulk of your cash or the entire remaining amount into this specific investment bucket. You feel a real pull to trade. Don't fight it. Build a separate account for your trading experiments. Fund it with money you can afford to lose. Cap this account at 5% of your total portfolio. Treat this cash as your personal casino. Execute trades. Scratch that itch. Learn from every trade you make. Maintain strict boundaries on this speculative bucket. House these trades inside a Roth IRA when possible. This account type keeps taxes from multiplying your losses. Your remaining 95% stays locked in boring index funds. You enjoy trading without endangering your retirement. Apply strict honesty to your personal scoreboard for step 3. Compare your exact returns against the index fund performance for the same time frame. Skip your single most profitable trading week. Count your screen time as a strict financial expense. You lose a fun hobby when you spend hundreds of hours to underperform a basic fund. You can buy that same fund in 10 seconds. You choose a bad career and pay yourself a negative wage. You face real danger when you confuse constant clicking with financial progress. Tyler fell for this exact trick. He cheered for weekly victories while emptying his bank account and wasting a second lifetime of personal hours. Regular investors fail to earn money through pure effort. The vast majority build their wealth through long-term waiting. Daily screen time adds zero extra wealth. The three men in our example all attempted to scatter their cash across the entire stock market. Envision one single investor skipping both day trading and actual broad market index funds. This person picks one excellent business in 1995, buys the shares, and leaves the portfolio untouched for 3 full decades. The final portfolio balance produces some unexpected and surprising math. We will explore that specific investment scenario in our very next video.